An average 30-year-old worker pulling in $60,000 a year has a median net worth of just about $7,000. By the time they hit 40, even with an upgraded salary of $80,000, they barely manage to accumulate $18,000 to their name. And by age 50, even those pulling in stable six-figure salaries typically sit on a modest $43,000 in total net worth. This isn't some cherry-pick depressing outlier data. These are the real median financial benchmarks of the average working population. That means exactly half of the people around you are performing even worse and drowning in an even deeper financial hole. The wildest part is that these individuals have established careers, beautiful apartments, and brand new vehicles on financing. The on-paper cost of those cars often completely eclipses the entire real net worth of the owners driving them. They handle real, solid money over a 40-year career, even with modest earnings. Well over $1 million will pass right through their hands. Yet, despite this massive lifetime inflow, 3/4 of them will never accumulate $100,000 in actual lasting wealth. They won't have it locked in retirement accounts. They won't have it in investment portfolios. And they won't have it under a mattress. The cash flows in, the cash flows out, and at the end of every month, year, and decade, their real net worth remains an absolute zero. So where on earth do all those millions go that you spend your entire life working to bring in? Right now, I am going to show you why hitting your first 100,000 is a brutal psychological gauntlet that most people fail. But once you unlock why this exact benchmark is so incredibly difficult to cross, you will realize why it is the only milestone that actually matters. At the $100,000 mark, a powerful threshold effect kicks in that completely rewrites the mechanics of how money works. The first 100,000 is an absolute war of pure personal discipline, but the second 100,000 is just simple math. We are going to expose the 4 critical traps keeping you stuck below 6 figures and figure out exactly how to bypass the system. By the way, I built a free early retirement calculator because most online versions are engineered with fundamentally broken logic. This tool uses strict Vanguard framework logic to expose the weak nodes in your strategy, requiring only an email to send your report. The link is waiting for you in the description below, and now let's jump back into rebooting your operational system. Think of wealth building like an old school arcade game machine where you constantly feed quarters into the slot. You feed token after token into the machine, but absolutely nothing happens on the display, making you feel like you're just losing capital. But if you possess the sheer stamina to reach a specific limit, the machine suddenly shifts and begins spitting tokens right back into your pocket. Over time, this automated inflow becomes exponentially larger than the baseline volume you were originally loading into it. That is exactly how the first 100,000 works. You feed the engine, your lifestyle doesn't improve, and it feels like a broken game. The masses quit investing during this phase because they do not understand that they simply haven't fully charged the machine yet. The first systemic trap on this path is the invisible tax on success, more commonly known as lifestyle creep. Let's say your current earnings sit at $55,000 a year and you manage to get by perfectly fine. Then you switch roles and your salary instantly jumps up to $70,000, a clean positive raise of $15,000. You feel like a total winner, but practically that new cash gets allocated to corporate pockets before you even think about it. You relocate to a nicer apartment because you can finally justify that extra bedroom. There goes $4,000 a year. You upgrade your vehicle because the old one looks unpolished for your professional status, deleting another $360 a month. You start eating out more frequently, selecting higher tier restaurants because you tell yourself you've earned it, shaving off another couple thousand. Throw in an expensive premium gym membership instead of the budget option, and a mountain of streaming subscriptions you never even open. Ultimately, your $15,000 salary raise has completely vaporized into a brand new set of permanent recurring overhead expenses. Your income scaled up, but due to structural inefficiency, you still have an uninspiring zero left over at the end of the month. Your brain doesn't evaluate your current life based on your own past baseline, but rather against the social status of your peer group. You earn more, you feel entitled to consume more, and the entire consumer economy is precision engineered to help you do exactly that. Auto dealers, landlords, and retailers are not stupid. They know that when your income increases, they can charge you premium prices. And here is the brutal truth nobody wants to admit. Feeling wealthy and actually being wealthy are two completely different realities. Feeling wealthy is driving a finance luxury vehicle and living in a trendy, hyperinflated district of the city. Being wealthy is owning legitimate assets that could completely pay for that vehicle and housing without you ever working another day. One of these paths is simply renting an expensive carnival costume, while the other is true, unshakable economic sovereignty. An individual earning $60,000 who lives on 40 will always totally outpace someone making 120 who spends all of it. Our mathematical system is completely cynical, ruthless, and does not care about your social ambitions or fleeting peer emotions. Obviously, you require transportation and a roof over your head. Nobody is demanding you go live in a dark cave eating wild roots. But the deep-seated reflex to instantly balloon your life the moment your income ticks upward is a snare that resets wealth to zero. If your earnings scale up by 20% and you immediately expand your expenditures by that exact same amount, you are just running in place. The second trap within our matrix is the monthly payment mentality, which is buried so deeply in culture that most fail to spot it. Let's stress test your internal operating system. How much does a car cost? If your brain immediately outputted a monthly price, you are infected. This is the precise financial equivalent of assessing smoking based on a single puff's buzz, completely ignoring total long-term lung destruction. The absolute second you start framing purchases by how much per month, you completely forfeit control over the actual total cost of things. A $35,000 vehicle financed over 6 long years under an interest penalty will cost you roughly $400 monthly. It sounds highly manageable, but you are willingly agreeing to an asset that deletes a third of its value the second you exit the lot. You submerge yourself underwater immediately, and this financial iron weight is going to hang on your neck for 72 months. That is 6 prime years of your life where $400 from every single paycheck is locked down before you even see the cash. Next, stack on top of that the spiked insurance premiums, standard maintenance costs, and annual government registration fees for a new vehicle, and your highly comfortable monthly payment via a simple sleight of hand converts into a real $600 capital drainage stream. This toxic approach is everywhere now. Deferred plans for furniture, buy now, pay later apps, and credit cards charging 29% later. The modern consumer economy restructured itself entirely to force you to look exclusively at the monthly microtag instead of total price. Because the exact millisecond you default to that logic, you are guaranteed to purchase overpriced junk you cannot legitimately afford. Online auto payment calculators are not engineered to preserve your wealth. They function solely to optimize the dealership's profit margin. Every single one of these micropayments acts as a heavy cast iron anchor that completely deadlocks your true investment firepower. You destroy your health working, bring home the cash, but the matrix splits it instantly. Car note, credit card minimums, and tech financing. In the final tally, nothing remains, and individuals waste their highest performing decades trapped on this exhausting financial treadmill. Capital enters the account and immediately flies right back out to service debt loops on assets that lose value every single day. The third trap is a total failure to calculate time arbitrage, meaning people completely forfeit the insane power of compounding asset growth. The masses naively assume they can build up their first 100,000 by simply stacking physical cash bills inside a savings account. They schedule entering the stock market for some mythical future date, when income grows, when the market stabilizes, or when they feel ready. But this imaginary later permanently shifts into a classic never, and their prime mathematical compounding decades vanish. Look at this basic math. If you invest just $50 a week starting at the early age of 25, assuming a standard historical market return of 8%, you will hit $100,000 by your mid-30s. But if you delay this exact system by just 10 years and start at 35, by age 45, you will possess exactly half that amount. The exact same volume of capital going in, the exact same market performance, but your final balance is sliced down by 50%. Compounding capital demands time, but time is precisely the one critical ingredient that people stubbornly refuse to allocate to their money. It is hilarious to watch investors waste hours researching which index fund has the lowest possible decimal fee structure, yet they feel totally comfortable delaying the start of their actual investing by 5 full years because they are waiting to feel financially stable. That 5-year tactical pause will cost you more than a lifetime of management fees across any fund marketplace. The global stock market does not care about your internal anxiety or emotional state. The index will not pause its engine for you. Elite tax lawyers and veteran wealth accountants never attempt to predict the perfect entry point or time the bottom of a market cycle. They simply systematically deploy cash into assets month after month because time in the market systematically obliterates trying to time it. The fourth trap is total asset confusion, where ordinary people prove completely incapable of separating an asset from a liability. The middle class genuinely believes that their personal finance vehicle is a premium asset. It is a textbook liability that drains cash flow. They view their designer luxury wardrobe as an asset, even though it retains less than 10 cents on the dollar the second they exit the store. Premium furniture, high-end electronics, and shiny collectibles are not wealth blocks. They are just exceptionally expensive home decorations. A real asset is something that automatically funnels cash into your checking account or appreciates in baseline value while you sleep. This means low-fee index funds, equity stocks, corporate bonds, or properly structured cash-flowing residential real estate. The middle class hoards liabilities and mislabels them, whereas wealthy operators aggressively maximize real assets first, Only later do they leverage the organic dividend yields from those assets to fund whatever luxury liabilities and toys they want. A shocking number of high-income professionals are functionally broke because every dollar that enters their system is immediately converted into liabilities. Look at Investor A. Modest apartment, 10-year-old paid-off sedan, but systematically deploys $1,000 every month into an index fund. Compare that to Investor B. Double the income, luxury high-rise lease, premium sports car financing, and invests a flat zero into the market. Fast forward 10 years, Investor A controls an unshakable, self-sustaining wealth portfolio compounding rapidly at 8% a year. Meanwhile, Investor B has nothing to show for their career but a stack of old receipts and a perpetual lease payment cycle. Why is the $100,000 mark so critical? It isn't an arbitrary number, it is a geometric, mathematical tipping point. Once your portfolio clears this exact barrier, compound interest officially begins generating wealth faster than your physical labor. Pushing from zero to your first 100,000 can easily take 8 long years of severe discipline and self-imposed limitations. But scaling from 100 to 200,000 takes just 4 years, and moving from 200 to 400 requires less than 3. The velocity of your wealth expansion trends upward exponentially because you have finally loaded a critical volume of quarters into the engine. Eradicate toxic liabilities, build your cash defense buffer, automate your index fund accumulation, deploy the blueprint, and win.